Good Tuesday morning, guys. My name is Jerry Miller, and welcome to Real Talk, an insider's guide to real estate life and the pursuit of happiness. We're live in Charlottesville, across the Commonwealth, the country, and the world on the I Love CVille Network. We're presented by Realty Partners. We're powered by the supply chain of real estate here in Central Virginia. Look at the bottom of the screen, and you will see the businesses and brands that you can count on to get to the closing table. This show, buckle up, giddy up, and get ready. Judah Wickhauer, studio camera, please, and let's welcome a true cast of characters to the I Love CVille Network. Antonio Banderas, we also call him Alex Urpí, the CEO of Emergent Financial Services. The closer, Mariano Rivera, we also call him Xavier Urpí. This guy is A-plus people. Nickolas Urpi, the CMO, we call him the social media ninja. And the distinguished gentleman, Keith Smith,
and Keith,
one of the principals of Yes Realty Partners. Que pasa, chicos? Good morning. How is everybody doing?
Fantastico,
very well.
Right?
Muy bien, muy bien.
Wonderful. To quote Xavier, we're all above the mud.
Yeah, there you go.
Good day today. I've been wanting to do this for a while, particularly with Nick sitting to my left. I really want to see how this whole fight for the microphone is going to go. Right?
So do I.
I think I may win, but I also play a little dirty. So I might end up.
No, you might not win.
There you go. So I've been looking to do. We had such a great time the last time we were talking, and we had a couple of bullet points, and the feed took over, and we went nutty. But I think for the few people in the world that may not know who you guys are and what you do and how you help folks, to include the Smiths, I'll let whoever wants to jump in first and tell about what you guys do and your wonderful businesses that you guys run.
I'll go ahead.
Go for it.
I'll go ahead and go first. I've practiced this.
Antonio goes first?
Antonio goes first. I've memorized these lines perfectly.
Antonio Banderas, Zorro times.
Zorro times, yes. Yeah.
Catherine Zeta-Jones times.
No.
Exactly. We'll leave out the later
movies.
We'll leave out the Expendables version of Antonio Banderas.
I don't know about that. I like the version, what was it, the Mexican, when it was him and
was it Brad Pitt?
No, not Brad Pitt. Guys that did the pirate movies. What's his name? Johnny Depp did this thing. Oh yeah, you got to go see that.
I gotta watch that.
Well done.
I gotta watch that movie.
It's pre that. So it's pretty good movie.
Oh, I'm gonna check that out.
He plays like a modern Zorro.
Which is good. He's good in Zorro.
Yeah. I'm sorry. I'll shut up.
Oh, but anyway.
Emergent Financial
Services to get back on topic. He was having a good time. No, basically what we are is a independent registered investment advisor. And that sounds really fancy, but what it really means is the independent part is it's just us. We're a family-owned business that we help people save for retirement. We help companies with their retirement plans, so your IRAs, your 401ks, how to set them up, what's the proper investments for all your employees, what are the financial plans you need to get from here to retirement. As you approach retirement, we do everything from the Social Security analysis, when should you be taking it, how you withdraw, how much you should be withdrawing from your IRAs, your Roth IRAs, how to structure your retirement. And the fee-only part just means that we don't do commissions and all those other things. And registered investment advisor means that we're registered with the SEC, so they come after us if we try to do anything funky.
Interesting. The other thing that we always forget to mention sometimes, because we always talk about retirement because that's so important, right? Because your funds, when you put funds in a retirement account, they grow tax-free, and we just love that, right? Anything that they don't tax you on, we just get really giddy and excited about, right? However, this just, I know that, me too. You could play that 10 times on that one, right?
Taxes, we don't like those.
Exactly. The issue, though, is that there's a lot of people that come to us and say, okay, here, I'm just beginning to save, right? But I have to figure out how much I can save. What's my budget? How much should I be spending on specific items? And we help them through that process and figure out, here's what you can do and here's how much you should save. And sometimes it's in their 401k. In other words, we don't benefit from it at all, but it's like in their case, we say, wait a minute, you should be putting more money into 401k because the company matches and it's free money, right? And then other times, as I mentioned, there are people who come to us and say, I'm thinking of selling this home, or I'm thinking of doing this. Is this the right move to do tax-wise, strategy-wise? Should I refinance? So there's a lot that goes on in what we do. Obviously, the goal is to get you to a point where eventually you feel really good about your future, your retirement, or maybe the time that you want to buy a house. You may want to buy a house when you're 35 years old, right? that seems to be the case these days, right? More or less, millennials.
We bought our first home at 24, but
24.
That was like back in the Stone Age.
Well, me too, yeah.
When you
Well,
actually
yeah.
could.
Mine was
actually could
before
do
the
that.
Stone Age, yeah.
But I'm handing this off to Nick because I want to hear some awesome wisdom from Nick here.
Oh, well, actually,
Go
Xavier
for it.
was covering my area because what we
Because
talk
you do
about.
most of the
I
financial
do most of
planning.
the financial planning. So, like, Alex and Xavier, we kind of like have proportioned off different like areas that we kind of specialize in. Alex and Xavier do a lot of the portfolio management. Obviously, Xavier, as the closer, like has his hand in these tentacles and everything, right? Because it's
Be
great
careful, he's
to
going to call me
benefit
the
from
octopus
his
now.
wisdom. Yeah, the octopus. Yeah, Jerry's
I don't want that.
new nickname. I like that better.
No.
But
Closer.
the closer, yeah, better than the octopus, yeah. But I think one of the things about the financial planning is that you tend to look right. The difference is, like as we mentioned, we tend to always talk about the retirement planning because this is what most people think of first as a financial advisor. But there's all these other areas where it's sort of like, well, do you have insurance needs that you're missing? Do you have, are you going to be withdrawing too much at the point at which you start to retire? And we start looking at those like rates and numbers and so there's a whole lot that goes into the financial planning aspect that not everyone needs or thinks they need at first, but like people will come in for retirement planning and be like, well, let's take a look at all these other things because it could be that you're missing something and you don't even know it because it's all part of your like including real estate, right? It's all part of your financial life, right? Real estate, look at the transition.
Look at that transition, Nick. I'm thoroughly impressed. We spend a lot of prep time, but not enough. Look, you're not the closer. You're the senior statesman, right? You're the one that comes in and kind of just makes
He closes the deal.
Closes the deal.
Yeah.
He's the closer. So,
You kind of got beat up there.
I did, yeah.
Well, that's what his role is. Isn't that his role with the team?
Yeah.
But he's right. I mean, Keith is right. I mean, there's a certain element where, because of the fact there's some gray hair, just a few, strands, of course, just because there's a few.
People are lying to you. You got a lot.
Really? Okay.
Just want to let you know. You got a lot.
Okay, just because there's just
And it
a
looks
lot of
awfully
gray hair.
sharp on you, by the way.
Thank you. Then people just feel more comfortable. It's like you tell them. I've been around the block a few times, and there's, and let's face it, there's a lot of older people that or people that are ready to retire or retirement that just feel much more comfortable with saying,
Sure.
yeah, you were here in the 70s, the 80s,
Exactly.
and 90s. You know what it's all about. Therefore, I feel more comfortable.
You've seen the ups and the downs.
That's
and
exactly.
You know how to relate to that.
That's right.
So I wrote a word down, family, right, as you guys were talking, right? I come from a family business. We talked about this in the last show. You guys come from a family business. Mom's involved in it, younger brother. So talk about that, man. That is not a normal course of business these days. So talk about what's the dynamic on that at the Urpí dinner table?
It's a fun dynamic. I mean, I would say at the dinner table we don't often talk business.
Good job.
We will kind of leave business behind, and once we get home, and really we just enjoy each other's company and just have family dinner. We'll chat over some wine. We'll talk about a little history, other things. But what's beautiful is I think you kind of touched on it. It's not common today, but there was a time in human history when it was very common that you worked in a family trade with people that you could learn from, people that you could trust. Because let's face it, they always say like blood is thicker than water, right? There's a trust element that comes when you're working with your family. There's a camaraderie, an ability to share thoughts very easily. When we have our Monday morning meetings to just go over, in particular, what we're thinking for the week, what we're thinking about the markets, where the economy is going, there's sort of a trust that you can say what's really on your mind.
Notice you can disagree with me. That's what they're trying to say.
Well, it's
you can disagree
true,
with anyone.
but wait a second. But that's one of the things I wanted to see is that was the beauty of it. Is that one actually kind of interesting story. So my father has us every time we are ready to do a sort of like our asset rebalance or an asset allocation. He has all of us on our own, completely separate from each other without talking, come up with what we think should be the asset allocations for each like client base or just like for our portfolios.
The basic idea before we begin to customize to the
right.
client.
So
And
like
how often did the results match up?
Never.
Never.
They never like there's always a degree, and the thing is, we'll sit there and talk, and the thing about being a family is like I always see on LinkedIn, like how do you talk about your boss about this and whatever. It's like we're a family, so if I disagree with Alex, we're gonna have that conversation until we come up with the best allocation for our clients. Nobody's going to hold back and be like, well, I don't want to step
only
on
have
the
to say yes
CEO's
to the
toes.
boss.
You know what I'm saying? Because the CEO's my brother, so if I think he's wrong, I'm going to say it. And if he thinks I'm wrong, we're going to say it. And then my father will come in and sort of like come up with this sort of compromise resolve, and then we'll end up in reality always with the best allocation for our clients, because because it's interesting enough, we're all family, so we think a lot of things similarly, but we're also different enough that there's variation to that. Right?
I would say you guys are pretty different.
We are pretty different.
Yeah. Personality-wise, certainly.
Personality-wise, yes.
Yeah.
So I'm the oldest of 5, and every one of us have a different personality. But Yonna and I are asked all the time, so, how do you do this? How do you, run a business as a family? So I come from a family construction business end of it. And kudos to you guys, because you guys actually did it the right way. You defined roles very in the beginning. Who are these defined roles? And everybody understands what those defined roles are. And the second thing that you guys are able to do just by listening to you all is collaboration, right? Which you don't see a lot of, unfortunately, in today's world, where different opinions come together and you collaborate and you end up in the best financial situation for the Smiths. So kudos. We need a clap for that. That really doesn't happen very often. So kudos to you guys.
So I'll just go in a quick story, right? So when I used to work at Smith Barney, same thing. Every Monday morning at 7 o'clock, we'd meet. We'd have the head guy. We have all the portfolio managers and the analysts, and then the analysts would talk about the specific stock that they researched the previous week or month or whatever it may be, right? And all the portfolio managers. Now, there was only 2 fixed income portfolio managers. So I was one of 2 fixed, and everybody else was equity. But it was uncanny that no matter what the portfolio managers felt, in the sense of, I really think I like this stock, if the head guy would say, I'm not crazy about that, I'm not sure about that, nobody would buy the stock, right? And it's interesting because I would notice that most of the portfolio managers were reticent about saying, you may not like it, but the analyst likes it, I like it, so I'm going to put it in my portfolio. And they had the ability. In other words, the portfolio manager had the ability to do whatever he wanted. The beauty about being a family is that we're not afraid to voice our opinion, right, and say, no, I think you're wrong, and here's why, right? You wouldn't do that typically. I mean, I was, 22, 23 years old. I wouldn't have gone to my boss, who's 50 years old, saying, you're wrong. I mean, when it came to interest rates, I would say, I think he's got it all wrong. But I'm 22, he's 50, he's got to know it, right? So you don't voice your opinion, and by not voicing your opinion, he's not getting a different perspective and say, I never thought of that, right? Or I might have said, gee, I never thought of what you were thinking.
But that's what you guys do.
And that's the beauty, because we're not afraid to hurt each other's feelings because we're blood. It's like, well, you're a dummy, you're an idiot, you don't know this. And I show them, and it's like...
my answer to that always, I know it, but please don't tell me that all the time. I'm going to start believing it after a while.
So I think from that perspective, being family is what's good about that.
Well, I'll tell you, it sold Yonna and I, right, into moving our funds over to you, our investments over to you guys. It made a difference. It was family. I'll tell you the thing that made the difference also on that was, we never on the show point fingers at anybody or other folks in the industries and all this stuff. But I'll tell you what I most liked about it was, we're not big investors. We don't have a huge pot of money, right? It's actually kind of small, frankly. But you guys were like, okay, let's do it. We can help you. We can take this small little pot and grow it. Where we're currently at, it's pretty hard to get the phone call back and stuff like that. So talk about who you serve, because you serve a pretty unique niche of folks, or trying to serve a pretty unique niche of folks. Is that a road you're willing to go down and talk about?
Absolutely. No, I mean, we're probably one of the few investment managers out there that does not have the asset minimum. That, in other words, doesn't say, if you don't have $250,000, don't bother walking in my door because I'm really not interested. And we'll encounter numerous people who will come to us and say, I came to you guys because I went there and I went to this place and they said, you don't have $1 million, so I can't really help you. Or I went to this one, you don't have $5 million, so I can't help you. And I'm sitting there saying, $1 million sounded a lot to me. I mean, any of these numbers. But the important thing is, part of why we started the business was just a lot of people, a lot of Latinos even, with Forward Adelante, the Latino networking group that I volunteer with, coming up to especially to Nick and myself when we were in economic research, and asking, hey, no one will take me, no one's interested. Can you guys give me some advice on my finances, how I should be saving, what I should be buying? And of course, at that time, we weren't a registered investment advisor, so I had to say no, because you can't give investment advice unless you're registered. So finally, Nick and I talked it over. I said, my dad's in this business already. Yeah. We are already selling our research to investment advisors. Why not just go down this path ourselves? Because there's obviously a niche of people here. You know, particularly Latinos was probably foremost on our mind at that point, right. But we knew that if there are Latinos having this trouble, there are going to be other Charlottesvillians having this trouble. And being able to say, you know what, we're going to go for this niche to be able to provide this, because it's kind of sad, but there's a lot of the retirement account funds.
Well, let's talk about Latinos.
Yeah,
let's talk
absolutely.
about how important it is to have this conversation with them. I'd like you to explore that a little bit more, please.
Oh, absolutely. So a lot of Latinos, and I understand this ourselves, so we come from countries, right, where, or our parents, grandparents came from countries where the banking system isn't super trusted. It just isn't. And
the proverbial cash under the mattress.
Exactly.
Right.
So you have a lot of people who, in other words, they either have no savings or they have literally cash in their homes. And like I always say, if you are sitting on $50,000 your whole life saving in cash in your home, the Federal Reserve is coming in, the reverse tooth fairy, and taking
that's how
that
my
money.
Meme and Poppy were.
That's how I know, and that's how it is. And it's so sad because the way, particularly if you think about IRAs, Roth IRAs, the way all this is constructed is for, I would say, lower middle class people. It's not, because that stuff maxes out at $6,000. So if you're a super millionaire, you can still only put $6,000 in an IRA. It's not that you can shove $1 million in there. So it's designed for the average person, but the average person is least likely to know about it.
Well, the other thing
the Latinos least likely to know about it.
Think about it, you want to build up good also financial practices, right? Mm-hmm. So that you can get to the point where you learn how to save properly. But if a financial advisor is not coming in and helping you through that, like if there are people with budgeting problems or credit card debt, and you're not willing to talk and meet with them and help them through that, then you're in the same boat. You'll always be in the same boat in the sense that like you'll never get to the point where you can actually approach that financial advisor. So you're just in sort of like a vicious cycle of having poor practices, like not understanding how money works and how to save it, how to budget it, how to put it away into these IRAs and Roth accounts. And so you can't escape, you can't build the wealth, you know? Mm-hmm. So it's like those are the people that have the greatest need. So even though sometimes they're, those are the people you have to go to.
You know, Keith, one of the things that I've noticed is that sometimes there's a lot of people that they're nervous, they're afraid to even go to a financial advisor and ask questions. And mm-hmm. they may be nervous because they don't even know what to ask. And it's interesting because just last night I had a conversation with a prospect, and I could hear her frustration with the phone and saying, I need help, but I'm not even sure what to ask you or what to tell you because I'm not even sure my situation and what I should be doing. And the beauty of it is that, and so we've talked about this as a group, and what we try to do more than anything else is do a little bit of education mm-hmm. when they come into the office. Help them out, educate them as to what is the best strategy. Mm-hmm. And one of the things that we always talk about is emergency funds, and we say, do we have emergency funds just in case something happens where you know for 3-6 months mm-hmm. you'll survive? Well, if you create a Roth can be an emergency fund, right? And people don't even think about that. Don't know about that, right? So it's a great way because you've created a Roth that you can tap into anytime you want, but if you never need it, it's growing tax-free, so it's perfect. So it's the little things like that we try to bring people into the office, and so we can chat with them and say, you know, let's just talk and see how we can help, if we can help.
So you don't need a substantial amount of money. We talked about in the last show the old latte factor.
Exactly.
How a simple one
There's
less
some irony there.
Well, he brings that in on purpose.
Yeah.
So he can show.
That's a prop.
That's a prop.
Well, Shenandoah Joe's the sponsor of the show.
Okay,
there we go.
There's a little bit of that too. But it may have a little rum in it too. Who knows? But in any event, you know, it doesn't take. It's a couple of key points that I want to make sure folks who are listening kind of get right. One, don't be afraid to ask. We deal with this on the real estate side all the time, and I'm going to talk a little bit about that here in a minute. Second, you know, if you have zero, that's okay.
Yeah,
exactly.
Right? That's okay. And the third thing is to sit down with these gentlemen. Okay. Sit down with these gentlemen. Maybe not Nick. I'm only kidding. I just try.
Start with them. It's true. It starts with them, and then they flow over to me.
But the reality of let's try this a different way. Sit down with this family, right? Because family matters.
Right.
Sit down with this family, and it won't cost you anything, right? They will map out a plan and say, okay, Smith, stop buying these and buy one less of these, and this is what this is going to look like. But it's important for folks to know because they think, oh, well, if I don't have this amount of money and if I'm going to sit down, oh, my God, you're going to charge me. And we don't do that. So why don't one of you gentlemen tackle the process?
Yeah, a lot of people, I think, wrongly suspect that it's like a consulting business. In other words, the moment I walked in the door, if I'm talking with you for 20 minutes, you don't, and if we start chatting for 20 minutes, I'm going to get a bill for 20 minutes worth of just chatting. And it doesn't work that way. The consultation when you come in is free because that's not the goal, right? The goal is to get you to a good place financially where you have a nice retirement, but then we get paid, right? In other words, as our clients grow, that's how we get paid.
So you're in
more.
a relationship building business, not the transactional business, which we love.
Absolutely.
You're trusted advisors. You're the source of the source. And then when they raise a little bit of money, you send them over this way and you say, hey, I got a down payment, go buy it.
Exactly.
Go buy it.
And we educate, because I know even on the Latino point, I'm sure you encounter this sometimes, Keith, a lot of Latinos, they're very hesitant to even go to the home buying unless they have all the cash. In other words, and I'll often hear the phrase, no quiero endrogarme, which means I don't want to get hooked on drugs, but the drug is
interest rate,
interest.
Debt.
Is debt,
Yeah.
is the mortgage. And so a lot of the things, I can't buy a house because that's debt. I'm going to be in debt. It's no good. And so to sort of teach and say, no, there's bad debt, the 16% you're paying on your credit card, and there's good debt. And there are times when a mortgage is the right thing to do. And I'm sure you encounter this all the time. You have to sort of educate people, make them comfortable, and realize, no, it's not as scary as you think it is looking from the outside.
Right. Well, he had gone on a different direction. I was going to say the other thing about our firm is that we don't have proprietary funds. So one of the things, you go to some firms, we're not going to point fingers, however, they will
push you into certain funds.
They will put you in their own funds, right? Because sometimes they're housed by larger institutions that have.
How does that work?
So basically, what a lot of other businesses will do is that they'll draw you in as asset gatherers and be like, okay, we'll invest you in this stuff, but the stuff that they're investing you in is the stuff that the guys above have already created for them. They have no say in what they're investing you in. They're just going to put you in. That's almost like a robo fund kind of thing. They already have it all set up for them. Whereas with us, what we do is we do all our own research. So. And each one of us is looking at totally different things at totally different times, which is actually kind of interesting because we all have different perspectives, right? We tend to have the same philosophy, so we'll all have the same goals in mind when we're coming up with how should we structure the portfolio as a whole. But at the same time, the assets that we invest in, or the funds we invest in, we research all the funds that are in like different sectors or areas or have specific goals. Because, for instance, some funds will be income generating, right? The idea is for them to generate dividends and payments and income. Others will be like, we want to expose you to this sector. So you can think of like space robotics or biotechnology, whatever the case may be. So we'll structure portfolios based on doing research into what we're trying to accomplish. So we'll say, okay, we feel really strongly about the biotech sector over the next 10 to 20 years. Let's do some research into finding the best.
What's the best fund?
Yeah. Which is the best fund, not which is the fund that we're being paid to use or that we have to use.
There's no Urpí House fund.
Yeah.
That said, well, this is the only biotech fund that we will buy for you because it's the one from the Urpí House.
Right. So the idea is to structure, so we can structure our portfolios based on the things that we find are the best. So we'll compile, Michael and I will go compile research, do research across several funds. I can see you reaching for it.
What sectors do you guys like?
What was the question?
What sectors do we like?
So we
biotech
talk about,
is actually one of them that we do like.
Oh, yeah. So we talk about that all the time, right? And I always tell people, even though we may like a particular sector, I think it would be incorrect to just invest your clients in that sector. And one of the things that people don't understand is diversity is the best way to have flexibility in your portfolio. Because think about this. Let's say you have two stocks, right? One stock goes up 50%, the other stock goes down 25%, right? What do? Do you sell the guy that's down 25% to buy something else, or do you sell the guy that's up 50% and you may like him? You have very little flexibility. If you have 10 stocks, one's up 50%, one's down 25%, all the guys in the middle, up and down, you have enormous flexibility to say, that guy, we bought him for this particular reason, he's okay, he's not doing a lot, he's the guy you might want to use to do something else. So diversity creates flexibility, right? So we may like a particular sector of the market, we'll invest them in a certain percent in that sector, but again, it's diversity that you want.
And at the end of the day, your clients will listen to you, right? If you make a suggestion, do you get
most of them?
Do you get any pushback a little bit?
It's very rare. It's very rare.
We'll have certain clients that they'll want a particular stock and they say, I want you to buy it. And what we then require of them, just to make sure everyone's clear, is on their investment plan, we'll say, you asked us to buy this, we're buying it. Done, make it clear, we're not telling you to buy this.
So we're going to do this live in front of everybody, which is our lunch meeting after this. So what do you think about the housing sector? It's a real estate show. What do you think about the housing sector?
And it's funny because it's one of the things I wanted to talk about here today.
Sure,
and
cool.
Not just because it's Real Talk, but because
our chemistry is so good.
Right,
it's the gray hair.
It is. But things since last time when we were here, that you were courageous enough to have us in the show last time.
No. The second invite was the courageous part. The first part I didn't know any better.
You didn't know what you were getting into.
Now I knew better, and I still did it.
Interest rates have spiked, right? I mean, you've got the 10-year is at about 1.5%.
So let's quantify which interest rates we're talking about.
So the 10-year Treasury.
So when you say that, and people listening, you don't think mortgage rates. So
right. Well, see, most mortgage rates are looking at the 10-year, right? I mean, the 30-year, the 15-year, they use the 10-year as the number, the interest rate that they're going to put their spread off, right?
The benchmark.
The benchmark, that's the word I was looking for. And the 10 years up, from 1% up to 1.5%, right? So it's up about 50 basis points. At 30 years up,
that's substantial.
That's substantial, absolutely. The only thing that's not up is really the very short end, the 3-month, the 6-month, exactly, the 1-year bill, right? These things haven't moved at all because the Fed hasn't done anything yet, right? This is all expectation. Now, what I thought was interesting, so you lived through 2008, I lived through 2008, 2007, 2008, 2006, and I remember in 2007, there was an enormous glut of interest-only, no down payment mortgages coming to the marketplace, and they were being pooled and sold, and I'm looking at them.
5-year ARM.
Yeah, I mean, just all different types. Especially back then, 5-year ARM, 7-year ARM, fixed 3-year ARM, and
it's a hustle.
Yeah, but I'm looking at it. I'm on the other side. I'm the investor. I'm looking at this and I'm saying, no skin in the game. No down payment. Right?
But that's not what's happening now.
No, but I wanted to bring, and I know it's not what's happening now, right? And again, the yield curve is completely different. So my suspicion is that most people are buying, homes and using either a 30-year or 15-year fixed rate. And if they're not, they should be because rates are so low. But what I saw the other day caught my eye, and then this is a name that I know you love, Zillow. They basically are
trying to get me into trouble, Xavier.
My job.
I'd love to hear this.
Zillow has essentially gone out there and told people, okay, you know what? We'll just buy your house. Forget about going through the real estate.
You're talking about iBuying.
Yeah, and they're just buying houses, and then they're pooling these and creating mortgage-backed securities, right? And when they try to sell them to you, they basically say, we bought cheap. So the interest rate on these, mortgage-backed securities aren't great, 2.5%. It's like,
it's not much higher.
That's not much higher. Why am I buying this? But what they're telling you is that we bought these cheap because there was no broker dealer. We gave them the price, and they said, "Yeah, let's do this." So I don't have anything.
The best way to explain that.
No, this man's dropping knowledge here.
So my question to you is that to me is the beginning of a problem because from my angle is like I wouldn't touch those because you're telling me the only reason a good investment because those properties are going to continue to go up because they bought them cheap. Well, I don't buy bonds because I think the underlying assets were bought cheap, right? I buy them for different reasons, right? That may be one of the reasons. But so I'm throwing this only to you. Is like, what's your thought about that? Because that's a scary. That's an avenue to me is a little scary.
Yeah. So iBuying is a unique animal. It is very small in the nation marketplace, very laser focused in specific markets. Phoenix, Arizona, for instance, has quite a bit of it because there's some underperforming properties, and they go out and grab these underperforming properties. Frankly, I don't think you'll ever see iBuying over here. It's just that the market just won't let that to happen.
I think you're asking, will the houses continue to appreciate and go up in value? Is that what you're asking?
Well, the answer to that is yes, but it was
you're saying potentially no.
Yeah, well, again, it's a different perspective. Let's see what Keith says.
So it's real. I just want to be careful that you're putting more of a global, more macro comment to that. I don't know, did I impress you with that?
Macro, that's
what I
great.
thought.
Let me write that down.
Write that down. More macro. It's an economic term. You'll learn it.
Okay.
He's an expert.
Yeah. But that's a macro thing. And I just want to be careful that on the micro level, the market area, we don't kind of scare folks away from that end of it. Look, the reality of it is that there's very few markets that are not appreciating rapidly
Right now.
in the country.
Right.
So where these iBuyers work, and by the way, if you take a look at them and dig deep into them, they're not making any money. Right.
So what happens if the houses don't go up in value?
Yeah. No, and again, so I threw it to you because, again, I'm from a different perspective, right?
Sure.
They're selling these bonds to me and saying, here's why you should buy them. I'm looking at them, and it's like, so you're basically saying, here's...
From your perspective, I would stay away from it with a 10
Exactly,
foot
because
pole.
you're giving me a low interest rate and saying, well, the reason you should buy this is because the underlying collateral is going to go up, and I'm saying...
But in the general real estate market, it's not very impactful.
Right.
The percentage of it is extremely low,
Exactly.
and it's very laser focused in very specific markets. I don't see this expanding throughout. Now, if we end up with the 2006, 7, or 8 scenario, which everybody predicts will not happen, right? Then that will become a very different story.
Yeah. Well, certainly it's a different world. I mean, what happened in 2006, 2007 was people buying.
Well, I knew that was coming in 2006 and 2007 when I had bankers walking into my office offering me tens of millions of dollars of development money and pay me to borrow it. I was like, you need to leave now. Just see you later. It was the Wild West. There was no oversight. It was, a horrible situation. But we nationwide, if you just read all the things, the amount of equity that people have now is pretty high.
It is.
On this end of it.
Questions coming in. Neil Williamson, president of Free Enterprise Forum. Ooh, direct message question on the iWatch here coming in as well. Neil Williamson, Emergent Financial Services would be fantastic for your retirement and portfolio. And Vanessa Parkhill, we'll get to your question. Jamie Turner, we'll get to your statement. Grayson, we'll get to yours here on the iWatch. First, Neil, sorry for the quasi-political question. What investment sectors will benefit most from the bipartisan infrastructure bill? I like Cleveland Cliffs quite a bit, Neil Williamson, but these are the experts right here.
Well, it's interesting. One of the things that I'd hate to, I don't mean to top out by saying all, but I think part of what we're seeing is that the stock market benefits very much in totality.
From inflation. I mean, you also have the inflation perspective.
Right. From government spending, from the Federal Reserve continuing to need to make interest rates very low, the free money flowing in order to pay for what's doing. So when we see a $1.5 trillion bill, a $3.5 trillion proposal, what we think of instantly, right, is the Federal Reserve, to make this possible to be paid for, needs to keep the spigot going of the free money. And what we've seen over the past 10 plus years is that free money goes into the stock market.
Right.
And the stock market then benefits from it. And so we'll often have people saying, the PE ratio, so PE is price to earnings, right? So it's basically a measure of how expensive the stock market is, right? PE ratio is so high, the stock market's really expensive. It's historically higher than it's ever been. But you look forward thinking and say, well, maybe the old rules don't apply anymore because what we're seeing is an endless spigot. So that's what I would say. It's hard to pick out particular sectors, but the fact that the spigot is continuing to move means you
So not mining, not iron, not with all this infrastructure rollout. Biden's administration is planning?
The problem is with these bills, I think of this $1 trillion infrastructure bill, the amount that's physical infrastructure is far lower. I think it's maybe in the $100 billion range. So a lot of infrastructure is a lot of other things that aren't physical construction.
Sure.
So
Shovel-ready project.
Exactly. I mean,
the other thing I was going to say is
like
there's a lot of subsidies and other things that will go in, and a lot of spending that will go into areas that already have potential for growth. So it's not like you would be isolating them and being like, okay, now all of a sudden they were a sector that was going to go down and now they're going to go up. There's a lot of investors who are probably already in those spaces, and so especially if you're looking 10 to 20 years, it's, you're just going to sit back and be in those sectors regardless.
So, I mean, without any doubt, one of the areas that I think most people need to really focus on here during this cycle, right? And I agree with Alex. In other words, one of the things you have to think about
define cycle for a second.
Cycle meaning that we're going into a cycle now where we have, at least from what we see, is a higher inflation, right? We went from 10 years of very low inflation to now very, obviously an inflation rate. Yeah, it is. I can see that.
Phone and I happen to have it.
That is not true.
Thank you. So we're in a situation where inflation has picked up. We don't know exactly how long this is going to last, right? So what type of investment protects that a little bit more? And, real estate, without doubt, really jumps to the top of the list. When you think about the previous 10 years when inflation was low, real estate was not really, doing as well as many other stocks, right? So you can begin to shift your portfolio slightly towards a real estate investment strategy, right? And whether that means, you buy a second home, or you buy a first home, or you buy REITs, right? That, you buy some closed-end funds that have those type of investments. That's great, right? But again, it's important to realize that you're never going to invest that perfect portfolio to say, here's the bill that's coming out, and I know exactly what's going to happen, and I can pretty much, the only time I can say guarantee, I can guarantee you that it's not going to be as you expected, right?
Absolutely.
Because things change. So again,
change is guaranteed.
Change is guaranteed, exactly. And so you want to have that portfolio that's diversified. Now, Nickolas talked about it before. For example, if you believe in clean energy, if you believe in technology,
you don't try to plan
it's not something that's going to happen next month or this year. It's something that's going to happen over the next 10 years. So begin to put up.
I don't know, man. I think this this electric vehicle thing is really starting to grow. But I can hear the Bat Watch or the I Love Charlottesville watch going off. So I think Jerry's got some more questions.
We got a lot going on. I got some questions myself about me specifically, but first let's get to some of the viewers here.
That's better.
This is from Vanessa Parkhill. Vanessa, we love you when you watch the program. She has a very specific question. She says, I have a topic I've been thinking about that might be of interest to the audience. Income tax on internet gambling winnings. I'm not a tax expert, but I expect DraftKings and the like are probably obligated to send 1099s to those who win over $600 in a year. Wow. As I recall from listening to your show, the online sports betting is new to Virginia. I'd really hate to see those new to the fun of online gambling get caught off guard because they don't set aside some of their winnings to cover tax obligations.
And that's a great question. And
that's a very specific and great question.
That's a CPA question, it sounds like.
In many ways it is. The interesting thing is you always have to watch out for changing tax environment. Sure. That's one of the big things, even from an investment perspective, because you never want to just spend all your earnings, even from your investments, even if you got a brokerage account. You got to be very careful with how you structure what you're doing. Make sure that you can afford your taxes, and also balance it without paying too much at the beginning. Because, like I always say, if you're getting a tax refund, it means you gave the government an interest-free loan.
Too much money, yeah. You don't want that
for the previous year.
Yeah, but I agree with Alex. It's one of those things where you have to be cognizant of the fact that there may be changes from the tax perspective, right? But what happens there is between you and your tax person.
Yeah, and I did a little research on this. The fine print when you sign up for DraftKings acknowledges this.
Okay.
So when you open the account, they say, look, earnings over $600 are going to be taxed here. You're going to get a 1099. So that is very much in the fine print.
Exactly.
Okay,
They're
so there you are.
They're covering their tail. This question's coming in from Grayson, which is on the Bat Launch. And Grayson says, ETFs, mutual funds, individual stock positions, index funds. Please ask the Urpis about these and which they like best.
So we like all of the above at different times. So ETFs obviously are very low cost, and they're getting much better in the sense as Nickolas and Alex mentioned before, they focus on particular sectors. So if you like a particular sector, you can buy an ETF. It's a low cost fund. The difference really between an ETF, which is an exchange traded fund, and a mutual fund is that the exchange traded fund, the ETF, trades all day long. So you can buy or sell it at 10 o'clock in the morning, at 10:30 buy or sell it again, or whatever, anytime you want. The mutual fund just gets priced at the end of the day. So you put in your order, at the end of the day, they price a mutual fund, they figure out what the price of the fund is, how much money you put in there, divided by that amount, and that's how many shares you have.
There are really two methods, mutual funds, ETFs, two methods of getting into the stock market without having to pick individual stocks. So much more diversified way.
Safer place.
Exactly.
Exactly.
And index funds, so for the index funds, you can't directly buy index funds. So the S&P 500 is an index. You can't directly buy the index. You can buy an ETF or a mutual fund that attempts to replicate the performance of the index.
QQQ with the NASDAQ is a good
Exactly, with the NASDAQ, or I think SPX does the S&P 500. So you will want some index funds, right? So in other words, you want to be exposed to the S&P 500.
No doubt.
500 biggest stocks and then you will sort of complement that with your sectors. And then individual stocks, my always warning with individual stocks, just from a long-term perspective, is not that they can't be part of your portfolio, but I'll tell a little story that sort of does this. Nick and I used to provide, we would create universes of funds for companies that were thinking of creating new mutual funds. So they would say, I have this philosophy, can you guys whittle me down 3,000 stocks to 300 so that then my portfolio managers can pick from this 300.
Fascinating.
So we would do that and whittle it down, figure out the performance of that universe of stocks and make our recommendations. And a lot of times we would say, hey, look, this country that you want to be in, there's only 19 stocks here that fit your criteria. You should probably just buy all 19. And the portfolio manager people would say, no, we can pick the best ones, we'll pick the best 3. Right? There was one time where the 19 stocks.
There was 3 stocks, remember?
Well, there was one with 3,
yeah,
but the 19, no, the 19's more, all right, the 3 is better. There were 3 stocks.
So they created a fund that had 3 stocks?
No. So one of the sectors.
One particular sector that they wanted to be in, there were 3 stocks that fit their criteria.
Okay.
And we said, buy all 3. They bought 1. Out of the 3, they bought the one that was the loser. That one went down, the other 2 went up like 100%.
Well, why would those guys? That's the worst
because that's the danger.
Ever.
That's the danger of it. And it's not that they were bad portfolio. Remember, the best portfolio manager is about as good at picking individual stocks as the average person is on picking next week's NFL game winner.
Yeah, but the strategy of picking 1 versus 3 and
that's
hedging
the issue.
risk.
That's the issue.
That was the issue.
You want to be diversified. So if you have the opportunity, if you're sitting there saying, I believe in clean energy, right? Don't try to say, I believe in clean energy, and this is the one company that's going to do the electric vehicle that takes off. No. If you really believe in clean energy, you buy the sector. Right. Because you might be right, and if they take off, that's going to be great for you because you own a piece of them. You're in clean energy. If they don't take off and this other company ends up being the winner, now you still win. Yeah, granted, you don't win as much. You don't. Instead of going up 1,000%, maybe you'll only go up 100%. But you know what? In the long term, you want to be diversified and not. You got to take away as much of the stock-specific risk, that gambling risk, as you possibly can, and want to be focused on what's my long-term objective, what sector, what do I think is going to do well in the long term, not can I correctly guess the one company that will do better than all the others.
Well, because I was going to say, just to that point, there's also like subsectors, which is what I guess one Alex's point was illustrating, was that they were looking at basically, if you could think of the sector as being the entire country, I think in that case it was one of the South American.
Some South American country.
Yeah, Venezuela or
Was it Venezuela?
No.
Peru.
Peru.
Okay, it was Peru.
It was Peru, right? And on the sub company of that, like they were looking at mining. I think it was mining in Peru. So one of the things, though, like you can see with ETFs and funds, is that they'll also achieve different things. We're talking more macro, but
I wrote that down.
Yeah, but. But you can also look at so you can have macro sectors like clean energy, but there's a wide variety that stems from that as well, like electric vehicles or the people who produce batteries is the supply line. Like, so one of the things when you're doing research on ETFs or closed-end funds is that they can strategize in different way, and obviously they'll pick an ETF or a fund whichever way they think is the best way to either market or have their security in there. 1 second, Jeff, sir. And just 1 second. And so I guess my point is that the question you have to ask before you just straight up buy a fund is what is the goal of the fund too? Is it because you can find something that's clean energy, but is it clean energy as in they're producing solar panels, or is it clean energy as that they're producing cars for consumers, right? Or is it clean energy that they're going to have both? Now back to you.
I just wanted to say diversification matters.
Yeah,
Exactly.
To break it down into a third grade level, my level, diversification, but it matters in everything.
It does.
It matters in housing. It matters in your financing. So diversification is an important thing. If you get nailed into one too much sector, you're more than likely going to get hurt in business, right? If you're focusing on making one type of widget.
Yes, exactly.
And that one type of widget goes down.
You have nothing else.
I just wanted to break it into a micro.
On a micro scale.
Jamie Turner, the fans need this today. Y Mañana and Real Talk collaboration once a month. So much knowledge on the show today. Thank you. Jamie Turner, the mayor of Gordonsville. Thank you kindly for watching the program.
Jamie,
Woodbury
that's
Forest
in the
alumni.
works.
It's in the works.
So, gentlemen, where do we think we had a rough September?
Good. It was good.
Dry powder on the sidelines is good for a rough September. Invest and get in the game. How do we see Q4 playing out after what? September is historically the worst month of the year for the markets.
It is. It's one of those anomalies that happens.
We're also, let's face it, like I said, we're also in a situation where the Federal Reserve basically indicated that they're going to begin to
Stop tapering.
Yeah, they're going to,
they're going to start tapering.
They're going to start tapering in November. We don't know how much yet. Everybody's speculating on a different amount. And then they mentioned how they may raise rates in next year, right? So the market reacts to that immediately. The market doesn't wait for it to happen. It reacts. And we don't know what's going to happen. I mean, so between the fact that, let's face it, I mean, inflation is high and staying high, and people saying how long, and the Fed's saying, well, we think it's temporary, but temporary for 1 year, 2 years, 3 years.
What do you think it is?
I'll get there.
Got it.
I wish I had to be honest with you. Well, anyway, let me just finish this point. So the issue is there's just a lot of nuances going on right now that may begin to pull back a little bit on the market, right? Because it's gotten a little heavy. I mean, we got a $3.5 trillion spending plan coming with a lot of, I call it hair. I mean, that's the old days. They used to say that hair on it. And I'm saying, what good is this? What's it going to do for us? How's it really going to impact what we do? And then how's it going to impact the market? So there's a lot of nuances going on, and so again, as Keith just said, diversity is the key important thing. But without any doubt, if you're getting dividends, I would say put them on the sidelines right now. There's no reason why not. I mean, the market isn't even down 5% yet, and everybody's up in arms. Let's wait. When it's down 5-10%, then you say, where are we? What's going on? And should we reinvest?
Over the last 19 months.
Exactly. With regard to inflation, I mean, let's be honest. I've talked about this even on our show. There's two types of inflation. One inflation is just a lot of demand, right? And that demand is forcing basically prices to go up. I am not yes, there's a lot of demand, but the demand is not enormous. I know we're not seeing an economy around the globe that's booming.
Yeah, we're not at pre-2020 levels.
It wants to boom, I believe, but everything between the pandemic and the deltas,
inflation.
whatever. Yeah, so right now it's a supply inflation, right? So is that going to last? I don't know, depending what the governments around the world do. I mean, you look at Australia, you look at our own government. What it's doing, it's causing some of that. Will they stop? If the answer is yes, then I think inflation will die down.
Well, I'm not as smart as you guys about this stuff, right? You guys are super intelligent about it. But to me, I look at it at two levels. You've got supply, which I think is the real issue going on here. And there's supply as far as raw materials go and physical items. The real, in my opinion, the real inflation item to it is the lack of skilled labor, a lack of folks to actually part of it. Do the work. To me, I think that's larger than anything. Just in our little world and our little world of real estate, I have several closings that I'm delaying 1 month, as much as 2 months, because we can't find truck drivers. They can't find movers to come in and move them from one side of town to the other side of the town, from one part of the country to the other part of the country. And we are now dealing with trying to extend closings or doing, seller possessions and all these different tools that we have in our toolbox to keep that's one of the reasons I was late this morning. I was trying to figure out a way to get a mover in so we could close on something the end of this week, and I can't find one to help out a client. So to me, that's the big pushback on inflationary, which is causing meat to go up, fuel to go up. It's not the lack of oil or something along those lines. Am I off base here?
No, you're not off base. Again, that's all part of the issue, right? So there's just, it's not just one thing that creates inflation, it's a number of issues, right? And, without any doubt. Oil goes up, gasoline goes up, and of course, the trucker says, I'm not paying for it, you're paying for it. And
you got labor shortage,
and he says, exactly.
Housing inventory shortage.
All of that is pushing inflation. Now, if you take a step back, right, because of technology, I truly believe that eventually inflation will come down. Technology makes everything cheaper, right?
Because what you're saying, the technology is going to help offset the labor shortage, for example?
Oh yes, it can without any doubt, right? But all I'm saying is that when you saw inflation drop from essentially over the last 10 years. We had in 2008, you still had an enormous amount of money coming to the market, right? And everybody said, well, we're just going to get great inflation. No? We didn't. Why? Because technology. Technology really does pull down and help keep prices down, right? What we're seeing today is that there's just so many things going on that is causing the inflation, but we still have to think about it. We are technologically jumping leaps and bounds,
progress going on.
So that eventually will help out.
It's kind of funny because we were talking before the show how Nick always likes to bring up his little history bit, just so you know. And so famous book on economics, I'll tell you about it later, but one of the things they analyzed was what was one of the key aspects of economic growth that caused us to change from a pre-Malthusian economy, which we don't need to get into a pre-Malthusian economy or a Malthusian economy, and to the capitalist economy we have today. And one of the things that pushed forward, what it did was drop the cost of goods, was technology. They think that's basically the idea is that technology, if we're going to put it at third grade level, the technology
sixth grade
is technology was the key to bringing down prices so that standards of living would go up.
Amen.
So technology is always going to be the driving factor pushing things forward, right? Because what you do is you replace labor with capital, and then capital, or in the form of technology, brings down prices by making things more efficient.
Love you. Love that. A good example.
No, you'd love it.
A good example of this is McDonald's having to pay higher wages to employees, replacing those employees with kiosks in the restaurant, driving down labor as cost on their business, and then using the kiosk to process the orders, and then they can pass the savings on to the customers.
That's right.
That's what you're saying.
That's exactly what I'm saying.
So
it also ends up helping the labor market overall in the end. Sorry to interrupt, but it does. It helps. It was the only.
It helps the labor market.
It helps the labor market because then eventually you push basically. What it did in the old days and what it's still doing is pushing more and more people into skilled labors, opening new opportunities, and then all of a sudden you see. So actually, since the 1700s to now is the only time in history, the only period of history which is still continuing, where standards of living among the poorest classes have gone up. The only sustained period, because it's happened. It happened in the Roman Empire. It happened in the Han Dynasty in China. It has not happened sustained since then.
See, that's when you explain it like that, It's brilliant. When it's in the
makes more
comments,
sense.
what am I supposed to say?
Once he got off Malthusian, it started to make sense.
So good, my boy. So good, my boy.
So that's part of my job, right? Bringing in somebody actually that can say, look, to go back into the McDonald's thing, I was on the phone this weekend with my sister-in-law in Vienna, Austria, right? And they are delivering mail, FedEx, all this stuff by autonomous vehicles within a certain area within the certain zone of the city. So, the market, right? Capitalism, the market, right? It's gonna respond. It's gonna say, okay, here's a problem, let's go fix it. And the market has to, given the time and the tools. Can make that happen. How did I do that?
No, that's fantastic. That's fantastic.
and that's right.
That's what you see.
I have a couple of questions, but I think the feed is blowing up on Jerry.
No, please finish. Go
for Keith's
So
question.
I kind of want to switch gears a little bit to real estate a little bit more. Hey, that's what I do, so that's where I want to go with it. But I just you mentioned something earlier in the conversation about how people maybe even give up on finding fiscal health, right, and starting it. Well, we see this on the housing end of it. People are just giving up. And I had multiple conversations over the weekend. I just want to throw it out just for the panel to pick up. Young folks in their under 30s, a little north of 30 years old, did not understand how a mortgage works. And didn't understand that if you get a 30-year mortgage, your P&I, your principal and interest, is locked in for 30 years. And I was having this conversation with a young person. So I don't know how to get started to buy a house. How do I do that? And so I was asking her, well, what's going on with your rent? She says, well, it's going up 4% every year, 5% every year. I said, well, you realize the best way to hedge that type of inflation is to own, right? I just blew my mind that these young folks didn't know that. So I want to figure out a way to educate them and how I can help educate them. And I just wanted to throw this topic at the table, and particularly the young people here in the room, to see what they thought.
To know the difference between owning and renting is just so huge. And I understand that there's the barrier for some people. They feel that they have the barrier of the 20% down, but the difference is so huge because when you rent, right, you are putting everything into the pocket of the renter. That the person who owns the property you are renting from is collecting economic rent, meaning they're collecting money from you because of the situation that you were in. Whereas when you have the mortgage, you're putting equity in your home. Your debt. The time will come when each payment you do, if I'm correct, has a little bit of principal in there, even if at the beginning.
So at the beginning there's more interest.
Right? But there's always some principal.
Of course, always.
In my knowledge, so you're beginning to own the home over a long period of time. You are getting something out of it. And
so I had to explain the term equity and appreciation.
Wow.
To couple of people that had master's degrees in some high level education.
I have to,
the way it once was.
And they didn't understand it, and I had to actually, I whiteboarded it out, literally, that was at a job site. I took a pencil on a piece of drywall, and I mapped it out exactly how this works, and this particular individual's light bulb went on, and I said, look, you're paying $1,900 a month. For a little bit less than that, you can own.
I think part of it is also coming to an understanding of what certain professions do. Part of it is knowing that a realtor like you're not just there like as a guy whenever you're ready to buy a house, this guy all he does is sell you a home. Like that's literally no. You're there also to educate. You're there to tell them how this works. You're there to guide them through a process. And I think sometimes people have this notion of the financial advisor. He's just there to sell me stocks.
Well, that's the reason I started off with that, Alex.
To,
that's why I started off in the beginning of this conversation. How important it is that we do the same thing.
Right.
We'll sit down and have conversations with people that may not buy for 2 or 3 years, but we're saying, okay, talk to the Urpis, work on your financial situation, talk to Scott Morris, the mortgage folks, figure out how that wants to do, and let's figure out a plan that we can get you there. And when we get you there in 2 years, let's go and do it. So it's important for folks to know that we're all the trusted advisors. Everybody at this table is trusted advisors to help folks.
We're professionals, not salespeople. We don't just have this one thing that we sell.
Good point.
We're professionals. We know about what we're talking about.
That's right. Trusted advisors is the term I prefer.
I
like that.
Microphone because Alex is the educator. Alex is the educator.
Is that really?
I do like. I was always most drawn to the most tempted by the academic side. There was a time I had wanted to. There was a time I'd wanted to teach a little.
We have to behave, Nick. Yeah. Okay. Or not. Or not.
You know, Keith, it's interesting, but you know, the mortgage calculation is actually a very complex calculation, and people just can't get their head around it, right? But the important thing is, and I'm sure this is how you talk about it. In other words, once you buy a house, right, you've borrowed money, and every single month a piece of that house becomes yours.
Amen.
And the only difference is that as time goes by, that piece grows and grows. The beauty is, I tell people, is think about it. If you're 30 years old, at the end of 30 years, if you still have the same house, right? You're 60 years old. You're reaching retirement age. There's no more principal, no more interest. You're clear. The only thing, obviously, you still have taxes. You still have to, keep up the house, but you're done, right? You don't have to think about You don't have to think about rent. But not only that, maybe when you're 70, you say, "This house is too big. I need to go to Keith, sell this house, and see if Keith can find me a condo, a townhouse, or something smaller."
Happens all the time.
Yeah.
Happens all the time.
If you're renting, that doesn't happen.
You got something on the brain over there?
No, actually, the funny thing is on some topics,
He has nothing on that brain.
I take yes, I have nothing on my brain.
Some historical context to this conversation that you can pull out of that beautiful head.
I'm sure I could. I don't think it's necessary.
If I say Julius Caesar plus housing, you say.
I appreciate it. Well, no, it's just interesting because all I was thinking about is that when we do the financial planning side, one of the things we always make sure we have separate columns for and separate analysis for is the mortgage, right? When people are paying their mortgage. And it's just interesting because we were sitting here talking about it. It's not, one of the things I think when you would text us in advance, it was one of the things I thought it's true. It's not an inflationary expense. Like, it's fixed. So you pay it fixed. So the only thing we look at, which is why we separate it, because we will fire test people's, financial life with inflation, right? Different inflation numbers. And different
mortgages.
But the mortgage does not. The only thing we check for the mortgage is that some people will try to retire early, and then they'll have a certain period of years. So this is mostly geared to people who are thinking about retirement. But they'll have a certain period of years in which, because of the fact that their mortgage is a very significant expense compared to the rest of their expenses, it does deplete their
savings
slightly. So what we do then is we try to play around with everything else. How can we manage, either Social Security or their income or part-time work such that it diminishes the effect, or maybe pay off the mortgage early? Like, we'll work around depending on the situation, right? This is why we do customized portfolios, because everyone's going to be different given their work, given the type of mortgage they have, etc., the type of savings they have. But one of the things we do is, if you can just get rid of that spread, it's, that's one of the things we have to look at. And it's a powerful tool because then you don't have to withdraw from savings.
But and to oversimplify, Mrs. Smith accuses me of this on a regular basis. It actually combats inflation, right? So it stops inflation, but you actually can control this. You can buy one less of these, and you can actually pay to your principal an additional amount.
Exactly.
And I will say, I'm waiting for the days when we could sit back at a closing table and close a real estate deal, a transaction together. I miss those days. I miss that hour and a half around the table going through the package, because one of the things that always blows everybody's brains up is that mortgage. Come on,
prepayment.
No. What? Amortization table. Thank you.
Thank you, Judah.
The wizard. Thank you, sir.
Well done.
Well done. Thanks for the save, buddy.
Judah. We love you,
Well, look at he's turning red, right?
We love you, Judah B. Wickauer.
The amortization table. They don't get freaked out about the loan documents. They look at this 35 pages of numbers, and that's when we say, well, slow down. So look at this. Break out a laptop. If you pay an extra $100 a month to this, look how much extra money you put in your pocket.
That's right.
On that end of it. So home ownership actually can combat inflation if you buy one less of these a day.
Yeah.
Not from Shenandoah Joe, from someplace else, but you want to always buy from
Shenandoah Joe. Stay for far, we love you. You're 100% right. The only counterpoint to that would be increased taxes every year. And the increased taxes are going to go up every year no matter what. You are going to fix your overhead when it's tied to mortgage, but electric, taxes are definitely going to go up.
Plus maintenance.
Yeah, maintenance.
So there's other
Yeah.
other
Exactly.
costs.
There are other
to it.
costs. That's right.
But
But it's
again,
but it's
those
a
are
piece of
costs
equity.
to maintain an asset that you now have.
Right.
And you will increasingly have the more you pay it off. Whereas rent is a cost that
But it goes up every 3 to 4 to 5
rent can also go up
And it
every
brings
once
you
in a while,
nothing. You lose
and
it.
it brings you nothing. It's anything you pay in rent benefits your asset base zero. It does absolutely nothing for your asset base, whereas the maintenance and the taxes you pay are allowing you to maintain the asset, which is your home that you have, because it's very helpful when you hit that retirement and you sit there, and sometimes people forget about it. They'll often ask, like, should I do some real estate investment? Should I do some REITs, which is real estate investment trust? It's like you purchase it almost like a fund for real estate. And we'll sit there and say, you have a real estate asset. And they're like, what? And I'm like, your home that you had.
It's your largest.
And they'll be like, no, I have a mortgage. Like, no. Yes, you have a mortgage, but this is on its way to becoming a 100%
Well, so this goes
owned
back
asset.
to the education component, but speaking to the Latinos in particular, and some folks, they just like, well, I don't want to go into debt. Well, hold it, time out. It's a tool, right? It's no different than this iPhone. Right? You just need to know how to use the tool, and you need to get trusted advisors that know how to manage and how to educate you to help you use this tool. In my case, it's Jerry Miller. He says, stupid, use it this way. And then I go, oh, okay. And I use it this
Phone's
way.
not ringing the right way.
Exactly. We needed his help this morning with the phone.
Emergent Financial Services, you can tell, guys, is a trusted name in the game and someone you can count on for your generational wealth building and your retirement planning. These guys, A+ individuals. Xavier Urpí, I love to listen when you speak. I sincerely mean that. What is on that big, beautiful brain over there of yours?
No, I mean, you know, it's interesting, but I enjoy listening to Keith because he brings that perspective on real estate. And the one thing, it's like Alex said, the one thing that we always talk about when people come in, the first thing we talk about is their real estate, because that, you know, that's their biggest investment.
It will probably be the most significant asset you ever have.
On average.
On average. And it's a perfect example. You mentioned about, you know, do I put another $100 into my mortgage as to pay down my house, or do I take that $100 and invest it? And it's a decision that we make all the time with our clients to see what's the best, you know, strategy for them. So again, you know, real estate with what we do.
But the point I'm trying to make is $100 matters.
Matters.
Right?
Yes.
Right? $100 matters. It's
Yes.
not 1,000. It's not 100,000. It's not a million. $100 matters. $50 matters.
The $5 matters.
Knock it off.
No, Shenandoah Joe's is the great one. I'm talking $5 at a Starbucks or something.
$5 matters, right? And we talked about it in the last show about the latte factor and this whole formula that if you buy one less latte a day or whatever, it accumulates. But it's important, I think, for folks that are watching is $100 matters, $5 matters. Reaching the right trusted advisors matters, right? And, you know, I talk about this on the show all the time in my world. You know, this is going to be great, right? This is great for people 97% of the people who buy a home start on this iPhone, right? Statistically. 87% drop that iPhone and hire a trusted advisor. So, you know, it's a great place to start, but you got to hire a trusted advisor.
Oh, is that?
You know, and what I was going to, you know, that's a perfect point. You know, a lot of people use the robots to try to figure out the asset allocation, and after a few years,
the robots, like,
you know,
the little apps on your phone you save $5 a month,
the algorithms,
and it automatically.
And then after a few years, they come knocking on our door and saying, I have no clue. I mean, I lost money, and because the problem with algorithms, it's backward looking. They have no idea what's coming in the future.
Oh, amen to that.
Not that we know what's coming in the future, but we can say, here's what we truly believe. One, we know something about, for example, bonds. We know something, bonds are not going to have the same returns they had over the last 20 years. It's mathematics. It can't happen,
And this is coming from the bond guy.
Yeah, absolutely. So when I see people's portfolios, I say, this portfolio assumes that you're going to get the same return, and you're not. So therefore, right off the bat, the expectations for the future are wrong. Right? And so it's important to really to look at your portfolio, yes, partly historical, but also going forward, say tactically, what should we be doing?
So we call that on the show crystal balling, right? Let's crystal ball. Let's look into our crystal ball and see what our collective multiple decades of experience is telling us. So I'm going to keep it a little bit in real estate, guys. I'm going to ask you, what do you think the real estate industry is going to look like in 2022 and 2024?
Oh, do you really want to hear these answers?
No, I would really.
In 2022? Well, I'm a believer, right, and I think I wrote that in. I think real estate's going to do extremely well over the next 2-3 years.
How about
I just think
10 years from now, how the industry is going to change, and the impact,
so.
Technology is going to have on real estate.
Here's the thing, and people do that all the time. They just assume that technology can replace professionals like us, right? And so let me ask you a question. Would you just go to the technology, your phone, and say, I have a pain in my pancreas, right? What does it say? Okay, so, all right, so I got to take this pill. Would you do that? No.
First off, if you do that, it tells you you're going to die in 6 months.
Well, whatever. My point is, there are times where you know nothing about buying real estate. Right? Nothing. You don't know anything about a mortgage. You don't know anything about this particular house. Is it going to fall apart tomorrow, 10 years from now? What it has inside? You know, how much does it cost? Is the price right? You want to go to a professional. You want to talk to somebody. And I think eye to eye talking to people is still the most important thing.
I think that'll
I think in 10 years, I hope it doesn't change, but I think in 10 years that's still going to be the case.
So I joke around a little bit, but I love spreadsheets. It's like my
so
thing.
do I.
Same
it's
here.
my
I love
thing.
spreadsheets.
I'll share a spreadsheet with you that I created. I went back and looked at in our car footprint. Right, this is Charlottesville, Albemarle, Nelson, Louisa, Greene, and Fluvanna. Right, looked at sales. Just what sold year over year over year over year. I did it 20 years, and the reason I did that because it included the time of the great unpleasantness. Thank you. Thanks,
oh, you've been watching.
Neil Williamson's watching. That's from you, Neil.
That's Neil.
Neil, that was funny.
Yeah.
So we had negative years. Thank you, brother. We had positive. I set you next to because I needed a little bit of pat on the shoulder once in a while. He's not doing it. So anyway, I needed it from him. But
Yonna told me not to do that.
I know she did.
Yeah, she said no more ego from my husband.
Literally, she did say that. But the reality of it is, if you hold on to it for 20 years, to back into Xavier's thing, you're averaging, in regions a little bit different, anywhere between 3 to 6% year over year average appreciation. So it's going to go up.
Yeah.
It always goes up. Now, what it was 20 years ago versus today is a big delta between the two.
Exactly.
But it's gone up year over year. So I think it's safe to say, I think 10 years the market will be good. But, that's a pretty tough reach for a crystal ball. But I mean, Xavier, you were pretty aggressive on the 2 to 4 years. You're saying is going to be good.
I think so. Yeah, I think so. I mean, listen.
It's a supply issue.
Think about
supply and
exactly
demand.
right.
Supply and demand.
The millennials are a huge group, and they just started to buy. I mean, are they going to stop?
They
in
are
2 years?
the largest buying group by percentage of anything. You and I are falling off the wayside a little bit.
Yes,
but these two gentlemen,
the boomers,
the boomers, these two gentlemen to our lefts are the buying profile going forward.
Yeah, so I think that's going to continue to happen. But I was going to say, if you remember in the 70s, there was and not only in the 70s, I can't remember exactly now the time range, but there was a 10-year span there where the stock market was actually negative. I mean, you lost money.
That's
10
exactly
years, right? So we don't look at that and say that's what's going to happen tomorrow, whatever. You look at over 20, 30 years, what has
I remember when the stock market had a 5 in front of it, not, was 5,000 points, right?
Exactly. So I think it's the same thing with real estate. First of all, when you buy real estate, when you buy your home, you're not thinking about this is an investment and I expect to have a 20% return over the next 20 years, right? You don't think of it that way. You say, this is my home. This is where I want to live. I want it to be comfortable for me, right? The advantage of that is that in addition to that, it's a piece of equity. It's a piece of property that most likely is going to go up.
When we do our land trust classes, Greg Slater and I with Nest Realty, and we're having one coming up tomorrow, actually, we spend a lot of time talking about whiteboarding out what this actually means to the, because they don't, I mean, these are folks all over. We're teachers, professionals, engineers that attend these classes, and we whiteboard it into something Jerry and I are working on, trying a first-time home buyer kind of scenario, because it's just shocking to me that folks don't quite understand. Like, if I live in a house for 10 years and I make these extra payments and my appreciation and all this stuff, this is how much money I have at the end. They just don't understand it. And
we run those numbers because obviously that's easy, right? To plug in here's your mortgage, it's interest, principal. What if I add another $100 every single month? And we show them how instead of 30 years, you pay off your house in 20 years, 22 years, whatever that number may be. Yeah. So it's just incredible. You show that to people and just go, wow, that's great. But and the other beauty of it is that if you come to a point where it's 2019, 2020, and you get a pandemic and you lose your job, you don't have to put that $100 in. You say, I need that because I got to buy food.
Ooh, I have a great question for you.
Oh, no.
Go. You've got the mic.
I was going to say, if you wanted an education tip, we can go. I'll give you a little history and a little education tip, and this is for the audience too. One of the ways that Roman boys learned how to grow up is this is how they got their education.
This is a family show.
Yeah, I was just going to say that.
They did. Yeah, this is a family solution. They followed their fathers. Yeah. The father took them everywhere they went, and so they saw how deals were done. So one of the things is and this is the thing, just talking as Emergent Financial Services, if you've got a teenager with you that doesn't understand economics, doesn't understand saving, and you come to talk to us about your savings, bring them along and let them learn, and let them hear the conversations and understand how it works, because they're not getting it at school. The personal finance is not being taught. So if they got to come with you to talk to real estate agents, realtors, or I got your accent. I listen to you too much. Or financial advice.
Okay.
It is a good thing. It is a very good thing. Yeah.
What do you think, Xavier, would be something that could put the housing market on the skids?
Ooh,
nationally, 5.5 million units under inventory. This area is super hot because of quality of life. One of the reasons we all live here. What could put the market on the skids?
Interest rates.
Yeah.
If interest rates go really high, then I think
you think so?
Yes, I do.
So define high.
Yeah, I mean so. I think if interest rates start reaching,
and
I don't think it's going to get there, but I think it would have to be about 6 or 7% that will start putting it up, because house prices are already up, right? Now you add the interest rate,
it makes that
and the payment is going to balloon.
Nine folks out of 10 buy the house to their monthly payment, not how much it is, how much the interest rate is.
Exactly.
Is I'm spending X. This is let's figure out what kind of house I can how I can afford.
That's why I think it's going to boom, because you all know that I don't think interest rates are going up.
Well, I think you're going to see it in the 4s next year.
I think so.
I think you're going to see it
I
coming
don't
up
think that. Do you think that?
I don't think so.
Yeah.
Really?
Yeah.
No, I don't think that. So what's your prediction? 3s? Low, mid 3s?
We're talking about the 10-year?
No, we're talking about
the mortgage.
The mortgage. My apologies. Okay. So
absolutely.
Yeah. So I think
it'll be in the upper to high 3s. Maybe.
So mortgage rates are a little different, but I would say that 3.5% to 4% is probably what we're going to be next year.
Yeah. So if rates, how high do rates need to go for the housing market to get on the skids?
Would you say 6 to 7?
Yeah. So again, if U.S. Treasury hits around 5%, then mortgage spreads are going to be somewhere between 6 and 6.5. It's going to start impacting those payments without any doubt.
And the shocking thing is 6 and 6.5 is still such cheap money.
Oh, absolutely. I mean, it used to be. I mean, come on, we went to 14%, and you lived through that. My first mortgage was 15.75%. When I got to 6%, I was opening bottles of champagne, saying, "Oh, wow, this is great. It's just the rates that my parents used to pay."
My first one was 6 1/8.
Yeah,
that's cheap money.
Exactly. But now it's like, I'll take the.
Well, we've talked about this
2.5.
on the show for 2.5 years. My fear was everybody expected this to be the new norm. And it's not. It'll go up. I think interest rates will start creeping up. I think it just has to. The market is just going to do that. The Feds are going to make it happen. The bond market's going to make it happen.
You got something to say on that?
I don't know.
No.
I don't know about the Fed.
You don't think the Feds will?
He's basically going to say, why is the Fed going to tax itself?
Yeah,
that's basically what
exactly. I don't see. I think they have no incentive at this point for the foreseeable future to bump up the short-term rates.
Short-term rate.
They have no incentive because
they're taxing themselves.
Anytime they do it, they are taxing the United States Treasury.
I mean, you got another $3.5 trillion coming, right?
So how is this going to get better for my world, right? If we're just saying interest rates are going to stay south of 4.
Well, he's saying it's going to be amazing for your world.
He's
saying this is great.
You're in seventh heaven.
But it's not amazing for my world.
Why not?
If I can't find a house for Nick to buy, I don't get paid.
Why can't you find a house for Nick to buy? Because
there's nothing
the
to buy.
prices are going.
There's no inventory.
Well, that's a different story. That's
So
not tied to interest rates.
You guys are economists, so that's what I'm trying to ask the question.
Yeah, but I'm saying,
that's a supply
so
issue.
if the Fed raises rates, how is that going to help housing prices?
Well, because it'll shave off some of the people in the buyer pool. Maybe Nick can't afford. We just talked about this.
Yeah, so what you're saying is we got too much demand. We just got to get rid of the demand, as opposed to how do we fix supply?
Well, what time is it? 11:39. I think this gentleman has a show to.
No.
The market, in reality, so the market, in a normal scenario,
Supply is the answer.
Yeah, supply is the answer.
Jerry, it's 5.5 million units short.
Yeah.
This is new construction,
National-wise,
new construction short per NAR's numbers, per the what's the governmental budgeting acronym? The
OMB.
OMB, opposed to OMB's numbers, that we need to go ahead and produce somewhere between 1.5 and 2 million units a year just to keep up.
Just to keep up and not close that gap.
Not close that gap.
And that's good. I mean, isn't that good for the economy?
I think so.
That's fantastic for the economy. Because the minute somebody buys a house, guess what they also have to buy?
Furniture,
appliances, furniture,
they
have babies, diapers.
Handymen.
Well, it is. It's good for the economy if those units get built.
So you just echoed what Lisa Steravent says, the good doctor from Virginia Realtors. Number 2 in GDP in the state of Virginia, our industry, right? Number 1 is government.
Yeah. So let me answer this. This is a very pointed question for you guys. So if the rates go up, his prediction is the pool of buyers will be diminished.
Right.
I think we're all in agreement there.
Right.
So the multiple offer situations will turn into like 1 or 2 offer situations. Your statement is it's still not going to solve the supply issue. And if supply still stays extremely low, which we know it's going to stay extremely low, supply chains are pinched, 24% of new construction costs is bureaucratic red tape from local governments, et cetera, which is another show, and I know you have a lot to say about that, Xavier.
Hold it in.
So your prediction is we will continue to have increased housing prices, obscene demand that cannot be controlled or cannot be accommodated by the market, and housing prices continuing to go up, and up. So his field is going to continue to crush.
That's my opinion. Yeah, I mean, I don't.
Industry-wide, I totally agree.
Yeah.
Totally.
I mean, and again, everything is local, right? So in other words, there may be areas in this country where that's not the case.
Well, and
right?
behaviorally, sometimes people might get discouraged and say, "I'm not going to even bother." And you can't control people's behaviors and how they react. But the number one issue with all this stuff is you have supply and demand. And in a normal scenario, right? You think about any other good. There's a shortage of bread. What happens? Some entrepreneur says, "Not enough bread. Bread price is really high. I want to make some money. I'm going to make some bread." In a normal scenario, the market looks at extremely high housing prices, shortage of supply, and someone says, I'm going to go in, build more homes. The fact that it's not happening speaks to deeper issues.
Well, I was going to say...
But the difference is, it's much easier to make more bread than it is to create new homes.
Well, that's what I'm saying. That's the issue. The issue is the friction.
There's no more land.
The issue is the friction between the desire on the part of entrepreneurs to create more homes and the creation of those homes.
Some people will say, well, just let the market do its own thing.
But the issue is obviously...
I'm that guy.
But we know the fact that there's a 20% red tape, the fact that there's 24% red tape means there are obstacles that are preventing the market from responding.
That's exactly
the market cannot respond adequately when there is friction preventing it from doing so.
We're on the same page, right? The market wants to do that, but what controls our world? What controls the production of these 5.5 million units? Zoning. There is governmental restrictions. So this is the reason why I'm such an advocate for the missing middle. It's for 2 reasons. It's a physical thing, right? We need physical product. It's also a fiscal thing, right? Because what's happening is we're bookending on either side, right? Higher end, lower end, right? Exactly. There's nothing in the middle. And unless this missing middle comes up with a solution for it, which frankly requires governmental involvement, then the market can't respond to it. Does that make sense?
So it requires governmental less involved, like they're already so involved that they have to change the way they're doing things.
Look, I'll take a contrary position on it. Not that I necessarily believe it for sake of a talk show. I do believe it, actually. Some of these regulations are for good reasons, right? Right? Chesapeake Bay was falling apart, right? We now have a Chesapeake Bay Act that does it. The problem is it goes from one extreme to another. Right? And this is the government being involved in it. We talked about 2006, 2007, where this cup of coffee could have bought a $750,000 house. Now, the reason why I don't think we're going to go backwards, the fiscal requirements to get a loan these days are very stringent, which is not a bad thing.
No, it isn't.
Not a bad thing at all.
Ray Cadell says, in the world we're in now, and Ray Cadell's watching, we love you, Ray. In the world we're in now, the facts of the matter is, some people are just destined to rent for life.
Yeah, sure.
Yeah. And that's just what's going to happen, and we just have to accept it, and we just have to move forward.
Well,
I know it's not the American dream.
I don't want to be too
dire
dire in the sense of, since the beginning of time, though.
Say that.
That's nothing new.
That's not new.
Yeah.
Since the beginning of human
it's
history,
gotten
some
worse.
people have been destined to rent for life.
Yeah, it's gotten worse.
So my
gotten
mother and
worse.
father were the first generation. My mother and father were the first generation on both sides of the family to own a home. Everybody else, it's what you did in Brooklyn. You didn't own anything, you rented it.
Yeah.
You did it for generations and generations and generations. My mother and father was the first generation to own a home. My wife and I was the second generation. So out of how many generations this country's been around, this is only two generations of home ownership.
Home ownership is a newer phenomenon. Most of human history, you did not. There was not,
I was gonna
large
say,
home ownership.
one of the things
history guy, what do you think?
one of the things we're missing there. We're always talking about economics, right? But one of the things we're missing is that the goal of economics, right? One of the things you study, like the basic problem is scarcity, right? There is not enough stuff for the amount of people who want it. So what is the mechanism that comes in and regulates that? It's price, right? So the price isn't the problem. Price is the market solution to the problem.
Price is giving you information. Price is telling you something.
It's telling you what the issue is, which is scarcity. So the thing about when you talk about like having the demand, what you're doing is you're taking the demand slope and you're moving it in. You're compressing it. But the problem with that then is the quantity supplied goes down, because we know that's what happens when the demand curve moves in. Again, the solution to everything always tends to be the supply, because you move it out, what happens? Prices go down, and the amount that you supplied, it goes up. So, I mean, if we're talking from an economic perspective, right, we're going to take a macro view. What we want is more of the stuff supplied, right? We want more houses to be supplied to the people who are looking for houses.
Well, the statistics prove that, right? Folks talk about, well, if missing middle comes in, if we create more supply, it's going to diminish the value of my property. And that's simply not the truth, right? Would you guys want to back any of that up? Do you agree or disagree with that?
I suspect, like everything else, is if you own a mansion and next door they start throwing condominiums, it's going to lower the price of your house. There's no doubt about it, right?
Statistically, that's not the case.
I'm not
and
sure.
We can prove that it's some
I don't know. Let's put it this way.
Well, here's the reality of it. Mrs. Smith is texting us. We're supposed to be eating lunch right now. So
what time is your meeting?
I told her we'd be ready at 11:30. So.
All right.
Poor Mrs. Smith.
Questions coming.
No. So I'm texting her. We're good.
Yeah. This is from Kevin Higgins for the Urpis. He says, I think China's real estate is 15% of their GDP. Can the Evergrande crisis impact our business here? And he says that's a question for all our guests.
Evergrande, the Chinese property management real estate company.
The largest in China. That is essentially bankrupt and defaulting. Well, I mean, they get a rescue line.
So here's, again, why did we decide to disinvest from China? If you notice what Evergrande is doing and what the Chinese government is telling them, says go ahead and pay all the bondholders in China. Do not pay any of the international bondholders. Again, this is a Chinese communist government. They can do whatever they want. That's fine with me. However, you got to be careful.
You got to be careful when investing.
I don't think Evergrande is going to impact this market very much, because I literally talk about homework. I went through all the bond mutual funds that I could find to see if I could find those guys. Certainly none of ours have them, and very few have them.
It impacted the markets for like 36
this is the
hours.
same.
Exactly.
36 hours.
Exactly. with the expectation something was going to happen, but so far nothing's happened. And would I recommend anybody buying Chinese stocks today? My answer is no.
Hell no. It's a hell no, isn't it?
Yeah, but I'm not. I'm a Catholic. Hell is bad.
Hell is bad.
Really? Did you just really say that?
Yeah, he's a Catholic.
Hell is very bad.
So I keep my Catholicism because I'm praying for purgatory, right? So,
my kids say that this is hell, this is purgatory. I'm like right here.
No.
So it's like
No, I think
I get it. I need elevator shoes to get me.
For the non-Catholics out there, purgatory is this kind of middle place.
We know what purgatory is. We know what purgatory is. So you think Evergrande is not something? It's not something to worry about now.
Yeah.
No,
So
US.
So this is the same country that's that can't supply enough energy to its factories. Have you guys read that article?
Rolling blackouts.
They are doing rolling blackouts in their factory areas because they can't produce enough energy to do that. And I come from a personal perspective. I lived under communism for half a decade, so anything with the communist government tied into it, I get a little skeptical. But that's because I lived under.
That's also. That's also. By the way, that's also the same government that is creating coal, right? Creating coal.
Oh, they're building coal plants around the world like crazy.
3 times more than anybody else.
And dialing
and you know
it.
why,
and the reason the power is going back, they're dialing it in their own country because they're out shipping all the thing. And I tell a story all the time. I was at Sofia, Bulgaria in 1985. I did not see a tomato for 5 years. Literally didn't see a tomato for 5 years. Went to Vienna to go visit the family, and there was these big, beautiful Bulgarian tomatoes. And I couldn't figure it out. What's up with that? Sorry, guys. I went off on a tangent.
That's what it is. That's what it is.
Perfect illustration.
So Mrs. Smith said we're on our own, so we're good to go. We're good to go.
Oh, you need Mrs. Smith there.
No, we're supposed to all get together.
I know, Guajiros.
Yeah, for a thing. But Mrs. Smith's going to move on, and she said, just be careful what you sign. I have no idea what she means by that.
Wow. Bring the other papers.
All right, now that Mrs. Smith's not there, let's change this up.
Yeah.
Man.
But so we covered a whole bunch in here, and for those who chimed in, I want to do this. Thank you. Thank you for those who chimed in. Thank you for whispering in my good hearing aid. The reality of it is we're going to do this regularly. Absolutely. Once a month. I think this is great to bring in the different perspectives from the real estate side and from the financial side. You've lost me in a couple of items there, but Jerry will educate me after it's over. And he goes, okay, dummy.
That's why I love y'all's show.
Yeah.
It's fantastic. You make complicated topics approachable. And I can only imagine when you're at the Emergent financial offices, you have even more time. It's even more approachable and much easier to understand.
I'll tell you, there are meetings where it's worthwhile probably videotaping.
I bet.
A true lesson, yeah.
And it's Tuesday tips.
Absolutely.
With Xavier Urpí.
Exactly.
Which you may see today on the I Love CVille show. Jude, I hope you have Tuesday tips ready to go.
So we're running out of time, and Jerry's got to get ready for the time. I actually printed a bunch of icebreaker questions that I wanted to get to doing it, but it looks we're going to save that for the next thing. But I'm going to ask one question, and we'll go around the table. What superpower you would have and why?
Oh.
What superpower?
Do I have to start?
No, you can if you don't want to, but you can. If you could pick a superpower, what would it be?
If I could pick a
superpower in the sense of
like a hero, like a Batman and Robin thing. What would be your superpower?
Superpower. That's a good question. Maybe.
Alex, how about
Xavier? I'll be honest with you. It's when I was a little boy, and I'd have to stick with it, right? Flash. I just love to run, and I said if I could just be like Flash,
And why?
Justice League, he saved the day. Let's be honest.
There you go.
They were all gone until he decided
bailed out
to
Superman and everybody.
Absolutely.
What do you think?
Either the flight or invisibility. I think being able
invisibility.
Being able to go places and do things without people
seen?
Not that I would do bad things, but it's always I would not do bad things.
But there's always confession.
Honestly,
there's always confession. But I think it could be a useful safety.
There's always confession, so you're good.
I would love to be able to see into the future, see what happens before everybody else, like Marty McFly with the DeLorean.
No.
Back to the Future.
Yes.
Where he took the DeLorean with the sports book.
That's
sports
right.
Almanac,
Exactly.
And then he mistakenly created Biff's World. Remember that? In Back to the Future too?
Yes.
But if you were able to see things before they happen, imagine the influence that you could have.
That's true.
Oh, sorry.
So that everyone else can hear too. I was gonna say mind control because like there's obvious things you can do with that, but the
Like the
problem is
X-Men?
I can't think of a single good thing I could do with it, so I should probably not say it. So that would be my answer.
Mind
And
control.
why?
Well, because you can control people. You can make them do whatever you want.
I have no interest in that.
You should have picked another one, buddy.
I know.
We just, there goes half the clients we could have had.
Yeah.
Wait a second.
I was trying to throw you a bone here, brother. Mine would be actually the same as Jerry's, which is really odd that our chemistry works this way. Would be to be able to see into the future, and not for McFlies and make money, but to help people, right?
Yeah.
You know, to say, hey, how can we make it better going forward? Well,
See, stuff that you could see, I just run into the future and say, no good.
That's true. The flash power lets him go to the future.
so I thought, Nick,
Is that what
you would
this Flash-
talk
The
something.
flash can go into
Yeah.
the future.
In the past, well, I mean, I had thought about like being able to time travel, but I was like,
Well,
that's another one.
Well, that's funny. One of the questions is here: if you could time travel, where would you go?
That's for next show, right? That's the next show.
We'll save that for another show.
Keep that one for next show. That's
I've
a
got
good one. That's a
102 of
good
them.
one.
It's okay. We're good.
Oh, we're good.
Periods in history for me we'd start on. You'd have to do a whole show of me just talking about
That's
different places that go.
We'll just hit the record button and we'll go out for a cocktail.
Exactly. Come
Come
back.
back
I
when
was
he's
just
done.
thinking, oh,
We'll make him think he's on air and then just.
So guys, thank you.
Thank
you very
Thank
much.
you.
This has been a lot of fun. I got an education. I hope other folks did get
So
an
did I.
education.
So do I,
So
yeah.
did I.
On that end of it, and we will schedule this again about a month from now.
Absolutely.
I love it. I love it. Alex Urpí, Xavier Urpí, Nickolas Urpi, 3 of the 4 gentlemen that comprise Emergent Financial Services, which, to be very frank, honest, approachable, genuine, just to trust the name of the game, Emergent Financial Services, generational wealth and retirement planning, and giving you the X's and O's to manage your finances, guys. Emergent Financial Services. Yes Realty Partners principal, one of 3 principals, Keith Smith, and this is Real Talk on the I Love CVille Network. For Judah Wickower, for Liza, the Caring for Creatures Rescue, my name is Jerry. Thank you for joining us on a glorious day to be above the mud. You guys, the I Love CVille show in 34 minutes. Take care. John, thank you. John.
Great show, gentlemen. Loved it.
Thank you, Keith.